Hello and welcome to the Technical Day Trader. Today we're looking at the stochastics oscillator, which was developed by George C. Lane back in the 1950s. It's also one of my favorite indicators. And basically what we're going to look at is the anatomy of the stochastics oscillator. Then we're going to see how it's calculated so you know what you're looking at. And then we're going to move in and see how it throws off oversold and overbought signals, and also some bearish and bullish divergences. Also at the end, you can look at our in-depth article, which identifies bull setups and bear setups, which was another signal that George C. Lane developed during that time. Alright, so first let's just take a look at the anatomy. I'll bring this up so it's a little bit easier to see. Here we have the stochastics. It's the default look back period for the stochastics is 14 days, which is why I have this little 14-day black block to kind of identify that. And you have a K% line represented in green here, and the D% line or percent D line is just a simple 3-day moving average of this K% line. So let's take a look at how this little baby's calculated. Okay, so basically it's an indicator that doesn't represent volume or price. It represents the speed or momentum in the change of price. So the way you calculate it is you look at the current close minus the lowest low and divide that by the highest high minus the lowest low times 100, and that's just to take the fraction away and give us a whole number reading. So basically what are we saying here? Well, we're looking at the relation of the close to the range, and then you divide that by the range over the look back period. So for just a simple example, let's say you had a stock that was trading around the $100 range, and its low was 100. Its high for the look back period of 14 days was 110. That's going to give us a range of $10. Now let's say it closed at 108. You take that away from the lowest low, giving us 8. And it's just as simple as 8 divided by 10, or 0.8 times 100 would give us a reading of 80. So it would be right at this level, right at the overbought line. And if you look down here, I have this little area, this little 14-day period highlighted, and you can actually see how it works, because at the beginning of the or at the end of the look back period right here, you see that this range, here's the high right here and here's the low, it's at the very tippity top of that range for the look back period. Well, what reading do we have down here? We have a reading of 94. So what it's saying is this stock is trading at the very highest of its highs right now. Okay, move forward a little bit, and then here's another little block. This is a 14-day block that I've highlighted here, and as you can see, here's the close on the final day that's looking back here, and you have the highest high, you have the lowest low right here, so that gives us our range, and the close was not at the bottom of the range but very close to it, and as you can see, the reading's there. It's at 20, which is the oversold reading. But as you can see, the very bottom of that range was closing in on 0. So this indicator it's range bound from 0 to 100, and then you get the overbought, oversold signals at 20 and 80. Okay, so now let's just take a quick look at some overbought, oversold signals. If I can get back here. And I have these pre-highlighted for you. Okay, so this is just looking at times when the stochastics is in an overbought above 80 or oversold below 20 situation, and I just highlighted it on the price chart so you can see. And I also have the Bollinger Bands overlaid. I usually have Bollinger Bands on all of my charts. It's a good upper overlay to just kind of give you a perspective on it. And as you can see, I mean, you're getting overbought signals, you get little sell-offs. Here's another overbought signal into a sell-off, and then your first oversold signal, you get a pop back to the 20-day SMA and the Bollinger Bands. That's a simple moving average. And then you kind of trend, you consolidate sideways, you get an oversold signal, sells off, hits that lower Bollinger Band, you get an oversold signal and you get a pop upwards. But as you can see here, you're getting a decrease in momentum. So after that pop, it hits and then sells off to another deeper oversold signal. And as you can, I mean, it basically continues on in that fashion. And these are just, 20 to 30 day in and outs for a stock that's jumping around a little bit and moving sideways. There's no defining trend. It's not in a big bullish trend or a well-defined bearish trend. So these signals are pretty valid to be able to get in and get out if you're going short or if you're going long. And okay, great. So let's move on to some bullish and bearish divergences. Now, the rules for looking for these. Here you go. This is of Intel. Is for a bullish divergence, you want the price to make a low. You get usually in the oversold. Or below the oversold, so that's 20 to 0. We got one right here, and what you want is price to continue to decline and make lower lows as the stochastics is making higher lows. And what that's indicating is that the momentum behind the lower lows in prices is kind of dwindling, and people are starting to look to the upside. And as you can see here, as prices were making lower lows, we got oversold, bounced up, then we hit oversold again, used it as support, bounced up, and then it doesn't even touch it, and off to the races we go. Now that was a pretty stellar earnings report that you get this little gap up here, but nonetheless, the signals were there. And then looking forward, you can actually see just right after that a bearish divergence, and what we're looking for there is a higher high in price as the stochastics is making lower lows, lower highs. And again, what that's indicating is that though prices are continuing higher, be it low volume or whatever the scenario is, momentum is shifting to the downside on this stock, even though prices are going higher. And as you can see, we get that result. It's going higher. We made a high in the overbought territory, and then made a higher high, though it wasn't a very much higher high. It was a higher high. But as that's happening, the stochastics is representing decreasing momentum on the upside, and then we get a support break at the 20-day SMA. You get a little gap down situation, and then from there, once that support is broken, it just becomes a selling fest pretty much. Okay, so that's it for today's quick trade video on the stochastics. Hopefully you enjoyed it, and we invite you to check out the full and in-depth article. It has also, again, like I said, George C. Lane's bull and bear setups, which are pretty cool little things, not signals I use all the time, but they're there for your enjoyment and your education. I hope you enjoyed it, and come back and see us soon. Have a good one.